Hello and welcome. This is a basic introduction to portfolio margin, an elective margin system available in Deribit for users with hedged positions. This guide will briefly cover how the default regular margin account works, a comparison to portfolio margin, the portfolio margin system and use case, as well as the interface panel and an explanation of the parameters. First, let's have a quick recap of how a regular margin account works. On a regular margin account, each position has separately calculated margin requirements. If you have multiple positions, these are simply added together to give you the total margin requirement for the account. Please note, a regular margin account is the default in Deribit. If you haven't specifically requested portfolio margin, you will have a regular margin account. Initial margin, or IM, is how much margin is required to open a position. Once you have no more spare initial margin, i.e. your IM bar is at 100% or above, you will no longer be able to open a new position until the initial margin usage has decreased below 100%. The maintenance margin, or MM, is how much margin is required to keep the position open. This will always be a lower amount than initial margin. If there is not enough margin left in your account to satisfy the maintenance margin requirements, your positions will begin to be liquidated. More on this in the liquidation lesson, a link in the video description below. With regular margin accounts, both IM and MM are calculated using fixed formulas, depending on the product. These are available in the Deribit documentation. Please note that IM and MM are not added together. If your initial margin is 13 BTC and maintenance margin is 10 BTC, you would need 13 BTC to open a position, and not 23. Portfolio margin, on the other hand, offers a completely different way of calculating the margin requirements. Instead of calculating the margin for each of the positions in an account separately, the portfolio margin system looks at how an entire portfolio of positions would perform together with changing market conditions. The performance of the whole account is tested against changes in several parameters. Whichever of these scenarios would inflict the largest loss to your portfolio, this loss amount is then used to calculate your margin requirements. Let's look at each of the parameters that go into the portfolio margin calculation, as well as where you can find them on the Deribit website. When you have portfolio margin enabled on your account, you will have access to the portfolio margin pop-up. This can be found in the Portfolio Margin tab in the Account Settings page. This pop-up displays both the current value of each of the parameters used in the calculation and all of your current positions with the corresponding margin calculations. At the top, we have the parameters used in the margin calculations. Next, the contingency totals for open positions. This figure is the total maintenance margin requirement of the account, including contingencies. These tables show a complete listing of positions and separated by perpetual and futures with options below. Now let's go into more detail about each of the parameters used in the calculations. As you might expect, the most notable parameter is a change in the underlying price. In the PM pop-up, you can see the current value. You can also see it being applied in the calculations as a range, with a percentage decrease in price to the left and a percentage increase in price to the right. What this means is that the system will look at how your positions as a whole would perform with a percentage increase in the underlying price of BTC and the same for a percentage decrease. Whichever scenario would result in the largest loss for your account, this amount is then used as your required maintenance margin. Please note, with portfolio margin, the initial margin is simply your maintenance margin plus 30%. So as a function, initial margin equals maintenance margin times 1.3. Although price movement is often the most significant factor, it's not the only change the portfolio is tested against. For options, another significant parameter that needs to be accounted for is the implied volatility, or IV. After all, if current IV is relatively low and the price moves down 10% in a day, the IV is likely to increase dramatically. This will greatly increase the mark prices of options and therefore the maintenance margin requirements. You can see the current range for both an increase and a decrease in IV below the price range. these values have automatically been taken into account in the options table, with whichever one would cause the greatest loss being used. Contingency amounts are added to the calculations for futures positions and options positions that are net short on a particular strike. You can see the contingency rates here, and the actual amounts for the current portfolio here. These contingencies ensure that there is a floor to how much margin positions will require, even when they offset each other, avoiding the possibility of a position requiring zero margin. Skew is a degree of distortion from a symmetrical distribution curve. Kurtosis is the measure of how steep this volatility curve is. You can see the current values being used in the calculations here. As you can see, the current portfolio margin calculation is quite a lot more complicated than the relatively simple formulas being used for regular margin accounts. While it has lower margin requirements for some, this complexity means portfolio margin certainly isn't for everyone. So, when is portfolio margin useful? Portfolio margin has clear advantages for positions that offset each other, as the maintenance margin requirements can be considerably lower. For example, option spreads, opposing futures positions, or a combination of futures and option positions. For example, if you wanted to sell a call spread, for instance selling BTC 27th December 19 $10,000 calls, and buying BTC 27th December 19 12,000 calls, your margin requirements will be significantly lower in a portfolio margin account because the potential losses from selling the $10,000 call are largely offset by the purchase of the $12,000 call. In a regular margin account, while the profit and loss would still be offset, the margin required would not be offset. There are also circumstances where portfolio margin is not useful. It is not always the case where portfolio margin lowers the margin requirements. For instance, directional futures positions that are not large enough to require over 10% maintenance margin in a regular account. This is due to the linear increase in margin requirements. These will actually have lower margin requirements with a regular margin account. If you're strictly going to be longing options, you may also choose to do this with a regular margin account instead of a portfolio margin account. In a regular margin account, when you buy an option, you pay the whole premium up front, so there is no chance of getting liquidated, and this is one of the biggest benefits to buying options. When you buy options with a portfolio margin account, the system may not need you to tie up the whole premium. This has the effect of building in some extra leverage to your position, and with leverage comes a possibility of liquidation. There are some minimum requirements for portfolio margin. To qualify for portfolio margin, you must maintain an account equity of at least 0.5 BTC and or 15 Ethereum. You must also confirm that you have an understanding of how portfolio margin works, as well as previous experience in trading options. If you do not have this experience, portfolio margin is not appropriate. However, it is possible to have it added to a testnet account first if you wish to try it out. To apply for portfolio margin, send an email to support@deribit.com. Unlike with a regular margin account where each open order takes up initial margin, the open orders in a portfolio margin account do not take up initial margin. For this reason, there are separate limits placed on the maximum number of open positions you may leave on the order books. You can see these limits in the Portfolio Margin tab, shown here. These limits will be related to the size of your account. They are necessary because no initial margin is tied up for open orders in a Portfolio Margin account, so they limit the possibility that a trader will leave more open orders than their account could possibly cope with should they be filled. Without these limits, the ability for a large price move to cause all of a trader's orders to fill and cause an instant liquidation would be too great. The liquidation process also works differently for portfolio margin accounts. The liquidation engine will aim to reduce the risk of your overall portfolio by first trading futures. This could result in opening new futures positions you didn't already have open. The goal is not to reduce your position size, but to reduce the risk of your portfolio by hedging your delta. This in turn should bring down your margin requirements back below your equity. Options may also be traded during the liquidation process. However, these will only reduce your positions. Whenever maintenance margin is higher than 100%, It is to the discretion of Deribit risk management how to handle your position in an attempt to reduce the risk of bankruptcy. To summarize, portfolio margin is a powerful tool that an experienced trader can use to reduce margin requirements on hedged positions. However, you should only enable portfolio margin if it will benefit your positions and you are very comfortable with using margin and leverage already. The two most obvious examples of where portfolio margin is undoubtedly beneficial are option spreads or portfolios, or futures positions that are so large that they require more than 10% maintenance margin due to the linear increase in maintenance margin calculations for regular margin accounts. While it is more complex, if portfolio margin is suitable for you, then it can greatly reduce your margin requirements. This was a brief summary on portfolio margin. Thank you very much for watching.